Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. After having set up a mega valuable enterprise in RGO and also managing to get in foreign funds, foreign equity in it in huge numbers and that too at an attractive price, Reliance is now attempting something similar in the retail space, in the e-commerce space. Its subsidiary, Reliance Retail Ventures, has been expanding its footprint in the retail e-commerce space at a fast pace. And for that, since September 2018, the company has been buying all kinds of startups in multiple sectors across the board in the e-commerce space. It has acquired companies like Netmeds, it bought a company called Grab, it bought C Square Information Technologies, it bought Find, it bought Haptic, it bought Waqt Holdings, and many others. In August 2020, it also acquired a company called Netmeds for a figure of 620 crores. And now the news comes that last week, Reliance acquired Urban Ladder for 182 crores. The point to note here is that while the August acquisition of Netmeds was at a sizable valuation and at a good premium, in the case of Urban Ladder, Reliance has managed to buy the company in what we call a distress sale, in a fire sale at a heavy discount. One was a case of the company being bought at a good premium, the other at a discount, both of course in the retail space, though in different verticals. While every company is unique, every company is different, its entire future potential etc. is different, yet let's compare these two acquisitions by Reliance, the acquisition of Netmeds and the acquisition now of Urban Ladder, and let's see what are the lessons or the emerging trends for acquisition of startups in India. Let's go through some relevant facts. Urban Ladder was set up in 2012. It has been based out of Bangalore, while Netmeds was set up in 2015 and it is based out of Chennai. The promoters of Urban Ladder have been IITians, Ashish Goel and Rajiv Srivats. On the other hand, the promoters of Netmeds is a traditional family who has been in pharma distribution business in Chennai right since 1914. It's the Dadda family and the investment has been spearheaded by its scion Pradeep Dadda. What has been the nature of business of these two companies? Urban Ladder has been a digital furniture portal. It is an online furniture and home decor company, and it has also set up a chain of retail stores, particularly in metros and tier 1 cities, in order to enable this business. On the other hand, Netmeds is what we call a licensed e-pharmacy. It is a portal for digital franchise in pharmaceutical distribution, and it has a much wider footprint. And by virtue of its digital franchise model, e-pharmacy, Netmeds manages to connect customers and pharmacies almost all over the country. Because of this, it delivers medicines at your doorstep. At the moment, this network of pharmacies sells over 70,000 products, which include prescription drugs, OTC items, and also health products. We then come to see what is the market presence of these two companies, because that has been a major determinant of their valuations. Urban Ladder has got presence in metros and tier 1 cities only. It is absent from tier 2 and tier 3 cities and towns, and because of this perhaps it doesn't have any mass based value added, value sensitive product or service for the masses. Because of that, its turnovers have not been built up. After all, those kind of products build volumes of business. On the other hand, Netmeds deals in almost every segment of the pharmacy business. It has got a presence in over 610 cities, and its network continues to expand such that so far it has serviced 4 million customers, and as we said, the numbers continue to rise. We then come to the industry potential. In the case of furniture business, at the moment, its annual turnover in India is about $32 billion. It is expected to rise to $61 billion in about 3 years' time. In other words, it may almost double. There are no regulatory issues, there are no legal issues in the matter of selling furniture online or otherwise. On the other hand, in the case of Netmeds, which is e-pharmacies, the growth potential is massive. Its present turnover of the industry is about $500 million. This is expected to balloon to $16 billion, which is a growth almost 32 times in a matter of 5 years. And this growth potential is expected despite the fact that there are regulatory issues, regulatory challenges in the matter of e-pharmacies. There are legal challenges. There is uncertainty about perhaps the very existence of e-pharmacy as a business, because brick and mortar pharmacies have been challenging this business. Despite that, the estimate is from $500 million turnover at the moment, the industry will balloon to $16 billion in a matter of 5 years. That's the kind of potential. We then come to impact of COVID on the business. In the case of furniture business, COVID had a very unfavorable impact, but in the case of e-pharmacies, it had a very favorable impact. Pre-COVID, e-pharmacies had dealt with 3.5 million households. At the moment, with COVID going on, the number of households that they have dealt with, sold goods to, has come to 8.8 million. After all, people in a lockdown have been resorting to e-commerce to buy their goods. Thus, COVID has had a very favorable impact on e-pharmacies. We then come to the capital raised by these two companies. Urban Ladder so far has managed to raise $114 million by way of capital. That is about 860 crores. And it has had a lot of marquee investors. Sequoia has been an investor, Elevation Capital has been an investor, Kalari has been an investor, Ratan Tata has been an investor in Urban Ladder. On the other hand, Netmeds has had low-key investors. It has got investments about $100 million so far. And who are they? It is Systema, an investor called Tancam, and Don Finn. Those are the investors in the case of Netmeds. Let's now look into the performance of these companies. They are both startups and both of them have been consistently loss-making. In the case of Urban Ladder, in the financial year 2017, on a turnover of 50 crores, it incurred a loss of 457 crores. In 2017-19, its turnover went up to 434 crores. It still had a loss of 49 crores. The company has been burning cash provided by the investors. In the case of Netmeds, it's a similar story. Its parent company, Vitalik Health, on a turnover of 184 crores in the year 2017, had a loss of 74 crores. Vitalik Health in the year 2019 incurred a loss of 184 crores on a turnover of 221 crores. That's the kind of loss that is being incurred by these entities. Vitalik Health also has a subsidiary called Netmed Marketplace. Netmed Marketplace had a turnover of 7.77 crores in 2020. On a turnover of 7.77 crores, it incurred a loss of 164 crores. In other words, in order to gain a toehold in the market, in order to expand their business, both these companies have raised money and burned the cash that came. They have been doing their businesses at a major loss. What has that resulted in terms of valuation? In the year 2018, Urban Ladder was valued at 1200 crores. In 2019, it was valued at 750 crores. Its valuation fell. And now, when Reliance acquired it, its valuation was a mere 190 crores as against investor money of 860 crores. In the case of Netmeds, the valuation on the basis of which this Reliance deal was done has been 1050 crores. That's the differing rate of valuation in these two entities. We'll come to that later. We now come to what has been the deal of these entities with Reliance. In the case of Urban Ladder, it was a distress sale. Reliance bought a 96% stake in Urban Ladder for 182 crores. And this deal was struck after months of protracted negotiation, in which, of course, we can see the valuation of Urban Ladder kept going southwards. Reliance does have an option to take a 100% stake in the company, and it has said that it will invest another 75 crores in its business by the year 2023. What has been Reliance's deal with Netmeds? In the case of Netmeds, Reliance has paid 620 crores in order to take a 60% stake in the parent company and a 100% stake in its subsidiaries. It can increase its shareholding in the company to 80% by the year 2024 and not beyond that. And unlike in the case of Urban Ladder, where the promoters are staying on only for the transition period of 1 year, on the other hand, in the case of Netmeds, it looks like that the promoter Pradeep Dadda is going to continue to manage the company even though it will be owned by Reliance. Thus, two different deals, entirely different valuations because of entirely different performance and industry perspectives. That gets us to why we are discussing this topic today, and which is what went wrong with Urban Ladder and what went right with Netmeds, and what is the conclusion. In the case of Urban Ladder, there was heavy competition from large, deep pocket competitors, which include Flipkart, Amazon, and the likes of IKEA. While competition came from deep pocketed investors, its present investors did not support it with any further investment. They were unwilling to invest any further money. Thus, Urban Ladder witnessed major shortage of capital, which affected its operations, which also affected its growth. But the biggest blunder in the case of Urban Ladder was its presence only in metros and tier 1 cities. It did not expect to expand to tier 2 and tier 3 cities. And because of that, the perception is that its potential is certainly limited. While all this was happening, it faced major issues of warehousing shortage and logistics issues. And that says why it failed and why its valuation was less. It was valued at a discount. On the other hand, Netmeds got it right. It operated all over the country. 610 cities so far and counting. Presence all over India. Presence in every product segment for every section of society. And that too with attractive discounts. And the most important, pandemic helped Netmeds. The industry expanded because of the lockdown, and that also became a factor for its valuation going up. The issue is, how do we conclude this? What are the larger issues? The first one is that when it comes to startups, which are all technology based, let's be clear, as soon as the technology or the business model or the idea is exposed, it is no longer unique. Competitors start coming into it immediately. And the only way to beat competition is to scale up at a furious pace, at a very fast pace. You have to build up scales, you have to build up volumes at such a fast pace that competitors cannot catch up with you. Urban Ladder failed to do that. Netmeds expects to do that with Reliance now coming in as a partner with deep pockets. The next is, of course, you need to keep upgrading your technology, you need to keep upgrading your business model and your products. Urban Ladder again failed to do that. And the most important lesson for startups, valuation is more a top line game than a bottom line gain. All these companies, whether it's Urban Ladder or whether it's Netmeds, have been incurring major losses, but the valuation factoring has been purely based on top line and the expected growth in the top line. The bottom line or the net profit was a secondary issue here. The top line was the primary one. Thus, for a successful startup, scale matters, speed matters, volume matters, top line matters. Bottom line can be a secondary issue. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.
If you like this video, please share it, and we would love to hear your comments in the comments section down here. Also, please do like our Facebook page and follow us on Twitter to get minute-to-minute news updates. For more such shows and videos, subscribe to our YouTube channel.